Hi everyone. In Chapter 9, we are now going to look at how companies use present value and determine what type of projects to take on. So now we're going to see some of these concepts we've been learning put into use. Specifically, we'll show you the reasons why what we call net present value criterion is the best way to evaluate a proposed project or investment. We're going to discuss something called the payback rule and why it's not really used except for really simple or easy decisions. We're going to discuss the discounted payback rule and some of its shortcomings, explain to you what the accounting rate of return is and some of the problems associated with them. Then we're going to look at what's called the internal rate of return criterion and its strengths and weaknesses. Near the end of the chapter, we're going to calculate the modified internal rate of return and then illustrate the profitability index and its relation to net present value. So there's that net present value coming back. So when we are trying to make a decision about a project, okay, and it notes it right on page 273. The most fundamental decision a business must make concerns its product line. We must strategically allocate our assets. In order to do that, capital budgeting, it's imperative that we properly capital budget beyond even financing. So financing, where do we get the money from? That's important. But the most important is deciding what capital projects need to be taken on. And that's what we talk about in the very beginning of the chapter. That's why you have a whole chapter on it. So we need to ask ourselves some of the following questions when we're evaluating what kind of projects to take on in a capital budget. Does the decision rule adjust for the time value of money? So when we're looking at our projects, are we doing anything with the time value of money? Present value, future value calculations. Does the decision rule adjust for risk? And does the decision rule provide information on whether we are creating value for the firm? And that's one of the keys. We have to be creating value. So all of these answers will help us determine if it's even worth undertaking a particular project. So the first way we determine or help evaluate for projects is taking a look at what we call the net present value. And this is the difference between the market value of a project and its cost. So we're looking to see, will this project create value? And it's that difference that will determine that. So how do we go about using this method? Well, the first thing you need to be able to do is estimate your future cash flow from the project. How much cash flow are you going to get over a period of time if you undertake this project, positive and negative? The second step is to estimate what kind of a return we need on this project for a risk level. And then the third step is to find the present value of those cash flows that we predicted using that required rate of return. Once we have that present value, subtract it from how much we have to pay up front for it. So you can see an illustration of how we would project the cash flows on page 275. So that's the outline of how we do the steps of this method. So let's say you have the following. You are reviewing a new project and have estimated the following cash flows. $165,000 you're going to have to expend today. Your cash flow the first year will be $63,120. Your Second year, 70,800. And the third year, 91,080. The average book value of the project is 72,000, and they give you the net income, it looks like. You're requiring a return for assets of this risk level, 12%. So how do we know what the net present value here is? Well, sorry, let's go back. We would need to determine the present value of all of these cash flows. So let's see if this one is in your book. Of course not. So let's do this. First of all, if we're requiring a rate of return of 12%, take the 63,000, we're going to go into our finance calculator. N is 1, so it's the end of year 1. We're going to have a 63,120. I is 12%. We're going to calculate for present value. Future value, 63,120. We're going to go back to present value, alpha, enter. So the present value of that future outflow will be 56,357. Let's do the same thing for the end of year 2's cash flow, but now we're going to change our N to 2. Our future value, 70,800. Go up and solve for present value, 56,441. And then our third year end. So N will be 3. Our future value, 91,080. Arrow up, present value. Solve for it is 64,829. So if we add those three amounts, those three present values together of those future cash flows, so I get 56,357 plus 56,441 plus 64,829. The cost, the present value of this project is 177,627. The cost is 165. Okay, so we're going to have positive cash flow of 177,627. Payout, that's the present value of those. Payout today, 165. So the difference is a positive 12,627. So you would take on this project. So if the net present value is positive, accept it. And it was in our case here. A net positive net present value means that the project is expected to add value to the firm and will therefore increase the wealth of the owners. That's our goal here, remember, in finance, increase owner wealth. So again, now there's the calculation. We would accept this project. Does it meet the decision criteria? Does the net present value rule account for the time value of money? Yes, it does. Does it account for the risk of the cash flows? Yes, it does. Does the rule provide an indication about the increase in value? Yes, it does. Should we consider the net present value rule for our primary decision rule? Probably. Now you could do the same calculation using your spreadsheet. So let's go ahead out. I'm going to stop sharing in PowerPoints and have you see my Excel. That's not it. Sorry about that. There we go. Okay, so you should see an Excel spreadsheet there. Your cash flows are negative 165. So 0 times 0, negative 165. At the end of 1, positive 63,120. End of year 2, positive 7,800. End of year 3, positive 91,080. Your required return is 12%. The correct way to do this is through a formula, and you can see up here in the formula bar, we have a net present value. So there's actually a formula already set up in Excel to do this calculation. The first amount you will put in there is the investment at time 0, B4. I'm sorry, the required return, I'm sorry, B4. Then you're going to show your cash inflows. Indicate the cells, C2 to E2. So that row of cells shows us the amounts that are in the future. And then we show the amount that's the investment today. So let me show you the formula dialog box. Let's do it this way. Go here, financial, NPV. There it is. And there's your dialog box. So the rate was the first item that was being cited, B4. So, whoops. The next says returns. Net present value. Value 1, 2, and 3 are the payments and income equally spaced in time and occurring at the end of each period. So that's where we get our C2 to E2. And, whoops. Trying to see on my dialog box. There we go. Okay, I'm done with that. What's next? Go up here and I'm going to put B2 and see what happens. And that's going to come out wrong because my formula is in there wrong. So let's do this. Ooh, it's off a little bit, huh? So, oh, okay. Just not sure how to get out of that dialog box to cite the investment outflow. So C2 to E2 cites the investment's cash inflow. B2, which will be outside of the parentheses, cites this is the investment, the outflow for the project. And that gives us our correct amount. Now, yeah, they're showing us the wrong way here. Don't put B2 to E2 as your cash flow because you leave positive cash flows together, so those future payments in this formula, and put the original investment outside of those parentheses because that's how the formula will treat it. Okay, so just so you saw it in Excel. So I'm going to go back to our PowerPoint and resume our show. Okay, so that's one way of determining if you should take on a project, net present value. Payback period, and it meets the criteria of being a good way to select a project. Now, there's other ways you could select a project. One is called payback period. So you can take a look and determine how long will it take to get the initial cost of the project back in a nominal sense, not a time value of money sense, but on a straight dollar. So you have to estimate your cash flow for the future and then subtract the future cash flows from that initial investment until you recovered your initial investment. Your decision here would be except if the payback period is less than some preset limit you've decided on. So it's not calculating, did you add value? It's saying, did you reach your time period goal? Take a look. Assume we will accept the project if it pays back within 2 years. So you initially outflow $165,000. The first year you get $63,120 of it back. The next year you get $70,800 of it back. So you still have, by the end of the second year, $31,080 to get back. In the third year, you make $91,000. So you make back your entire amount plus some. Do you accept or reject it? Well, you wanted to make it back within 2 years, so you would reject this. Again, does the payback rule account for the time value of money? No. Does it account for the risk of the cash flow? No. Does the payback rule provide an indication about the increase in value in the company? No, there's no indication of that. Should we consider it? Probably not. Because it ignores the time value of money. It requires an arbitrary cutoff point. Well, if we get our money back in 2 years, ignores cash flow beyond the cutoff date. So even if you make money beyond the cutoff date, it ignores that. That other 60 grand, who cares? Just as long as we do it within 2 years. That was the decision-making criteria. And it's biased against long-term projects. So it's easy to understand though, and it adjusts for uncertainty of later cash flows. So you don't have to worry about those later cash flows in your determination. And it's usually used for very short-term quick projects. So it's more biased towards liquidity, short-term stuff. So we wouldn't accept it because under those conditions, it says, no, you didn't meet your 2-year rule. But you could see the simplicity of this. So can you use it at all? Well, for very simple, quick decision making, not for longer term projects. Minor decisions are okay. The next method is called the discounted payback period. So now we're going to compute the present value of each cash flow and then determine how long it takes to pay back on a discounted basis. You compare this to some specified required period of time, and you accept the project if it pays back on a discounted basis within the specified time. So instead of just looking at, okay, we're gonna make 63,000 next year, 70,000 the next year, 90,000, by what year will we have our money back? Without calculating time value, that's payback. Discounted payback says, no, bring all those amounts back to present value, and based on their present value, how long will it take you to get your money back from the investment? So now assume we accept the project if it pays back on a discounted basis in 2 years. Well, what is the present value of $63,120? We already calculated that before. $56,357. So of the $165,000 present value, we receive $56,357 discounted back to present value by the end of year 1. The next year, we receive $56,441 because that is the present value of $70,800. But we're looking at it as of today. So present value wise of the $165,000, by the end of year 2, we get back $112,798. So we don't even get our return money by the end of year 2, even comparing present value to present value. It's not till sometime during year 3 that we recoup our money, comparing it on a present value. So present value of $91,080 was $64,829. So 112 plus 64,829 is 177,627. So it gives us our same answer as net present value. But here we're not asking did we add value to the company at all from this project? We're just saying, do we recoup our money at a present value discount by the end of year 2? And your answer is no. So we are looking at discounted payback. Does the discount payback account for the risk of the cash flows? Well, we're using our 12%, yes. Does it look at the increase in value? No. Should we consider it as our primary decision rule? Still, no. It includes time value of money. It's easy to understand. It does not accept negative estimated net present value investments. So this is only a good thing when everything's positive. Again, it's biased towards liquidity. The disadvantage, it may reject positive net present value investments because you're not looking beyond the payback period. You're just saying, when do we get our money back? Who cares about anything else beyond that? You have to pick some kind of arbitrary cutoff point. This is very biased against long-term projects. So again, it's good for minor decision making. It's better than the payback period because at least you're using time value of money. There's a great illustration on page 282 that could be used when we are doing a calculation for discounted payback period. And actually, this illustration is using future value instead of present value. Okay, so this will help us determine when cash flows of the project will equal the investment, but looking at it from a future value perspective. So take a look at that and ask any questions you may have. Now, the average accounting return. So there are many different definitions for the average accounting return, but here's how it's calculated. Some measure of average accounting profit divided by some measure of average accounting value. So what do we use? Average net income for a period of time divided by average book value of the assets. So average net income you find on your income statement. Average book value, remember, you find that in your balance sheet. You need to have a target cutoff rate for this. Accept the project if the average accounting return is greater than that preset rate that you determined. So in our example, a couple slides ago, let me go back to the original information here. Over here, they told us net income year 1, net income year 2, net income year 3. So we're going to add those 3 together, and then they told us the average book value. That's why they told us that, so that we calculate our average accounting return. So add those 3 together, divide by 3. So the average net income over the time of this project, $15,340. The average book value is $72,000. Now the company wants a 25% return. This will only provide for a 21.3%. So we would reject this project based on the average accounting return. Again, does it take the time value of money into effect? No. Does it account for the risk of cash flows? No. Does it say anything about increase in value? No. Should we consider it as our primary decision rule? No. It's easy to calculate, and the information is usually available right on the financial statements or projected financial statements. But it's not really giving us a true rate of return. It ignores time value of money. It uses this benchmark cutoff rate, and it's based on net income and book values, which have nothing to do with cash flows and market values. But it is another available method. We're just showing you them and why they're not really good. The next method, internal rate of return. This is probably the most important alternative to net present value. So net present value is your method. This method is often used in practice and is intuitively appealing. It's based entirely on the estimated cash flows and is independent of interest rates found elsewhere. Bottom of page 285. It's internal because it depends on the cash flows of a particular investment, not on rates offered elsewhere. It's acceptable if the internal rate of return exceeds the required rate of return. It should be rejected otherwise. The internal rate of return on an investment is the required return that results in a zero net present value when it is used as the discount rate. So internal rate of return is the return that makes your net present value zero. It's not negative and it's not positive. Remember what net present value is. Investment, which is your negative, compared to all the cash flows, subtract those two, it will be zero. If the internal rate of return is greater than the required rate of return, you will accept that project. So, how do we calculate that? If you do not have a financial calculator, it becomes a trial and error process. Okay, so you can enter the cash flows as you did with your net present value on your calculator, press internal rate of return, and then compute and see. Do we accept or reject this? We accept it. Now, let's get these numbers. I'm going to go back here, 16.13. Hi, everyone. I wanted to step aside actually for a few minutes there to make sure I knew how to use the calculator properly. So for those of us with the finance calculator, you can calculate your internal rate of return very easily using our finance app. And actually, you can calculate your net present value also on your finance calculator. There's some great videos too, by the way, on YouTube. But if you go into your apps and click on finance, now don't click on time value of money solver. If you arrow down, keep arrowing down, I go down to my number 8, and that's an IRR function. Enter. Now, your first formula, or first variable, I should say, that you want to put into your formula will be the initial outlay of your project, which would be the negative 165. Please put the negative in using the negative sign on your number pad. Then you should have a comma. Mine's right above my number pad on my calculator. And now you have to use, they call them the corleones. They're, if I said that right, they look like they're brackets, basically. They're not parentheses, they're brackets. And mine are in orange above my parenthesis buttons. So that means I have to hit my second orange button and then my left parenthesis to create that bracket. And now I'm going to put my cash outlays for the project, or cash inflows, I'm sorry, cash inflows from the project. So I'm going to go back to where we have that information right here. And I'm going to put in 63,120, comma, 7,800, comma, leave them in as positive because they're positive cash flows, 91,080. And now I have to close that bracket. So mine is by hitting my orange second key and the right parenthesis, and that will close the bracket. And then I'm just going to hit the right parenthesis. That's and when I say right parenthesis, the one that is actually the circle is actually pointing towards the left. So enter, and I get 16.313%. So that is how we use and can very easily calculate, let me get back to my slide here, internal rate of return using our calculator. There's also an Excel function. You could also calculate net present value, and I'm going to put the links for using the calculator out on Blackboard, so you can see using the various calculators how to create and determine these amounts. Otherwise, you're doing a trial and error process to find the required internal rate of return. Remember, what is that? That's the point where your present value, your net present value of your project is at 0. So the net present value of your cash flows equals your net cash outlay. So we would accept this project because it is a higher internal rate of return than what is required. So you can see that when net present value for this project is positive 60,000, okay, you're using a discount rate of 0. That's your discount rate here. As your discount rate increases, the net present value decreases. And we want to find the point where it reaches 0. So at any point above this, we have a positive, so we want to accept the project. As and this is the internal rate of return, as the discount rate goes beyond 16%, we enter into negative net present value. So does the internal rate of return rule account for time value of money? Yes, it does. It associates the risk of cash flows. Does it provide an indication about the increase in value? Yes, it does. Should we consider it? Yes, we should. So knowing a return is intuitively appealing. So it's just nice to know at what return do we need to make, or can we make, when net present value is 0. It's a simple way to communicate the value of a project who doesn't understand or know all the estimation details. And if your internal rate of return is high enough, you may not need to estimate a required return, which is often a difficult task to do anyway. So it's a great way to find your return. Remember, it is calculating a return at the point of 0. So in the next slides, we will have an example of using Excel. So I'm going to stop sharing this and share my Excel sheet with you now. So here is this the same one? No, that's not. Okay, so here is the formula for using internal rate of return. There it is up here in your bar. So it's very similar to what we do for our calculator. We're going to put equals IRR is the formula, start a parenthesis, and we want to tell it only look at the amounts in B2 through E2. So it knows the first one will be times 0, and the remainings are the end of the first year, the end of the second year, the end of the third year. And when you put that in, it will calculate your internal rate of return. So very easy to use. Then you can compare it to your required rate of return to see if you should accept the project or not. All righty. Going back. So take a look at what ended up being decided using each of these methods. If you use the net present value method, you would have accepted the project. If you use the payback period, you wouldn't have. If you use the discount payback, you wouldn't have, or the average accounting return, you wouldn't have. But the internal rate of return, you did. So you can see by choosing one method over another, it could really impact your decision making. So you want to use the method that's going to give you the best decision choice. So what is the difference? Net present value and internal rate of return will generally give us the same decision. Exceptions though. What if there's non-conventional cash flows, meaning sometimes there's positive cash flows, sometimes there's negative cash flow over the time period of the project? Or what if there's mutually exclusive projects? So meaning your initial investments are substantially different and the timing of cash flows is substantially different. Which one should you use? So when the cash flows change sign more than once, there's going to be more than one internal rate of return. So when you actually solve for your internal rate of return, you're solving for the root of an equation when you cross the x-axis more than once. There will be more than one return that solves the equation this means. So when you have more than one internal rate of return, which one do you use? Take a look. Suppose an investment will cost $90,000 initially and will generate the following cash flows. $132,000. Year 2, $100,000. Year 3, negative $150,000. The required rate of return is 15%. The internal rate of return on this project is at, it could be at 10.11% and 42.66%. So the internal rate of return flows over that that spectrum. So if your required rate of return is between 10.11 and 42.66, your net present value will be positive. You should accept it. And that's what that's saying. So the net present value is positive at a required rate of return of 15%, so you should accept it. If you use your financial calculator, you would get an IRR of 10.1, which would tell you to reject it. So you have to be careful when there's non-conventional cash flow. You need to recognize that there are non-conventional cash flows and look at the net present value profile. Now, what if there's mutually exclusive projects? So if you choose one, you can't choose the other. So you can choose to attend graduate school at either Harvard or Stanford, but not both. So when you have that kind of decision, you would use the following decision rules normally. If net present value, choose the project with the higher net present value. If you're using internal rate of return, choose the project with the higher internal rate of return. So suppose you had two projects, project A and B. The internal rate of return for project A is 19.43. For project B, it's 22.17. Net present value is 64.05 for project A, but 60.74 for project B. Which one do you accept? The required rate of return for both is 10%. You accept the one, okay? Take a look at the crossover point. The internal rate of return for A is 19.43%. And so there is our net present value decreases until It reaches zero at 19.43%. Net present value, the internal rate of return for project B when net present value is at zero is 22.17. Okay, so the crossover point of these two rates is at 11.18%. So net present value directly measures the increase in value to the firm. Whenever there's a conflict between this and another decision rule, you should always use net present value. So what this is saying is that internal rate of return calculation isn't reliable here. Okay, even though it looks like you should select the 22.17%. In reality, that's not a true rate of return when you're looking at mutual projects. You should select the one with the higher net present value.